Star of the show, talking to us today about trends going on in the M&A and a case study. And I know Manuel and his team at Ankura were very busy during COVID and since then, of course. But Manuel, as I mentioned, has a degree from a fine institution just down the road called the University of Houston. So right. Proud of you. Yeah.
Go Cooks.
He and his team, Manuel himself, has spent over 18 years in hospitality, tourism, leisure products, U.S., Latin America, Caribbean, and Europe. They do a lot of work, as you can see, market feasibility analysis, strategic planning, operational diagnostics, asset management, a lot of due diligence and restructuring. Also, they have a heavy litigation support practice as well, and they spend a lot of time on M&A and melding groups together. We're very fortunate to have Manuel with us today. Ladies and gentlemen, please welcome Manuel Bremont.
Thank you. Thank you, Dr. Barth. Is it on? Can you hear me? Okay, there you go. It's interesting, I started this conference as an attendee 20 years ago while I was still attending the Hilton College. So it's been quite the road, a very interesting one. And, you know, I'm glad to be back after, you know, a couple of years of breaks and, you know, Zoom meetings and webinars and whatnot. As Dr. Barth mentioned, our firm specializes in advisory services, primarily, you know, in hotel transactions, you know, going through the whole life cycle of a hotel project, from marketing feasibility studies to, you know, asset management, property management, restructurings, workouts, due diligence in connection with acquisitions and dispositions, and, you know, a lot of M&A activity. Leading up to the pandemic, we had been fairly busy with M&A transactions. In fact, the last two presentations that I did prior to the pandemic were around the trends that we had experienced and seen in the M&A world, working with the likes of Enbridge Hospitality, Belmont Hotels, Commune, Destination, a lot of the large third-party and brand management companies. And as I mentioned, one of the things that we do is you know, a lot of restructuring and workouts. And one thing that we noticed right after the pandemic is, boy, we're getting ready to be busy again, like extremely busy. And to our surprise, while there's certainly been a lot of distressed assets that you know, have hit the news and whatnot, the volume of workouts and restructurings is obviously a far cry from what we saw during the Great Depression. I mean, the collapse of Lehman Brothers by itself was worth billions and billions of dollars worth of troubled loans and just distressed assets. So indeed, the items that contributed to the Great Depression versus, the Great Recession versus, you know, the pandemic are, you know, quite different, right? One led by, you know, factors such as the collapse of the housing sector. The other one, you know, led by an external factor such as the pandemic. But what we noticed during the pandemic was a common denominator across most of the lenders that we work with. You know, despite the fact that the COVID-19 situation had a devastating impact on the lodging sector, not only on performance, but, you know, employment and, you know, everything that we all familiar with, we saw a period that was characterized by a wait-and-see approach from most of the lenders. And that was all led by uncertainty, not knowing exactly what was going to happen. And so what the lenders opted to do in most cases was, let's just wait and see, because we don't know how long is the pandemic going to last. We don't know if there's going to be a vaccine. that is going to help us, go through this situation. And so everybody was getting ready to, raise capital. There's actually still a lot of capital that's sitting on the sidelines waiting for those distressed sales to take place. But there was a lot of capital that was raised, getting ready to pick up all these trades that in most cases never materialized. I mean, in Manhattan, which is the subject which is the location of the hotel, which I'm going to go into a little bit more detail, there have been a number of distressed sales, the Sheraton Times Square, the Midtown DoubleTree, but most of those hotels, were hotels that were dragging some problems before the pandemic, big box hotels. We know that group business is still on the recovery path. So if you're a group hotel, you're probably still hurting, even though the industry continues to move on a path upwards. But what exactly does that wait and see period look like behind the scenes, right? In most of the discussions and the work that we have done with the financial institutions, a lot of the lenders essentially opted to negotiate an 18-month or 24-month forbearance agreement. They knew right off the bat that recovery was going to take a long time for the industry to go back to pre-pandemic levels. And so that led to them working with their borrowers and saying, look, we can sit all day and try to figure out the best path going forward, but probably the best way to go about this is just to wait it out and see what happens. On the flip side, and in some cases, what that has translated into is a constant battle between the borrowers, wanting to keep the hotel open, retain staff, and essentially avoid foreclosure at the end of the day, versus the lender's unwillingness to take back a hotel that is bleeding cash, and that in at least 2 years ago, in most cases would have traded for a significant loss, essentially impairing their ability to recover whatever the loan basis was. Now, this battle was not necessarily the prevalent scenario in most cases. I mean, we're obviously work with a number of institutions and borrowers where there has been mutual agreement and negotiations in good faith to essentially look for a path going forward. But in this presentation, what I would like to share with you is essentially a little bit of additional details as to how one of these workouts look like behind the scenes, and give you a little bit more details on the intricacies that essentially go behind a project like this. The subject is a 300-room full-service branded hotel located in Manhattan. The lender's debt position was a little bit over $50 million. The lenders were actually a group of financial institutions, one based in the US, the other one based out of Asia. So a little bit of despairing points of view in terms of how to approach this particular workout situation. The sponsors or the borrowers in this case were a pretty large private equity fund and a minority partner, which was a real estate / operating company here in the States. The hotel was built in 2010 and had not been renovated for 10 years plus, and it was undergoing construction. So it was almost worst case scenario because you're hitting the pandemic, you're in Manhattan, which is one of the markets that was hit probably the hardest, along with other markets like San Francisco, Miami, and whatnot. And you're in the middle of a $10 million renovation. So in April 2020, right when we were called by the lender to provide assistance, the borrower decided they were going to hand the keys back to the lender because they had defaulted on their loan, and they were going to halt construction unless the lender entertained negotiations for a debt restructure, or essentially find a way to negotiate a forbearance agreement. The lender said, we're willing to work with you, show us your restructuring proposal. And the first thing that came out of the borrower was a request for a little bit over 40% discount on what they owed to the lender. That was their initial ask. And clearly that did not go well with the lender, and they decided that it was gonna probably take a little bit longer to try to find a solution to this problem. In the meantime, you're sitting in limbo because the borrower still owes you money, they're in default. There's late penalties and fees and accrued late interest that is still racking up, and they needed to find a solution rather quickly. So the first question that they asked is, what are our options? Well, what we essentially told the lender was, you can keep the keys and try to sell the hotel, but you're probably going to lose more than 50% of whatever it's owed to you. So that's probably not a good choice. You can keep the keys and try to hold for the hotel and hope for the best, right? Again, uncertainty, not knowing when that's going to happen. It can take 3 years. It could take 6, 7 years. So are you willing to stay on board with this hotel for that long? And I think the view of the U.S. lender was that there was a possibility they could probably get comfortable with that situation, but the Asian bank said there's no way we can just take the risk for the next 6 or 7 years. So there was a constant battle internally among the lenders, because they didn't really have they weren't really in sync as to what the path forward was for this particular project. And so the last option was, let's try to negotiate with the borrower. And because that was the path of least resistance, then we helped the parties kind of come to an agreement. They signed a forbearance agreement, 6 months, that essentially waived all default interest, late penalties, and essentially allowed for the construction to resume. This was a construction that was not completed until October of 2021. And in the meantime, those negotiations continued. Now, the borrower agreed to continue with the construction because they had a completion guaranteed on the loan documents. So they essentially didn't have a way out unless this got escalated into litigation. So they took the option of, well, if they're waiving all these fees and all these interests, let's at least try to complete this so that we can get off the hook. And that's how we proceeded. Given that all of the alternatives were still on the table, right? I mean, this is just a temporary solution to the issue. The lenders essentially said, well, if we foreclose on this asset, or if we take the keys back, we cannot keep the management company because the management company is a subsidiary of the minority partner. So we needed to go out and try to find a new management company. We ran our RFP. We invited a number of companies. Challenge was, this is a non-union hotel. So that automatically narrows down your universe, particularly in Manhattan, where you wouldn't want to bring an operator that manages a union hotel, because then your hotel runs the risk of being unionized by a Christian. So we were able to successfully bridge that gap. Negotiated a management agreement with the operator that was selected, all contingent upon the lenders eventually taking back the property. And obviously the negotiation was another subject, and I know Cliff talked about hot issues on management agreements earlier, but what does the term need to look like under pandemic scenario, right? How can we terminate this if we decide to close the hotel? What are your fees going to look like if we partially close down the hotel, or if we decide to go a different route? All these issues had to be addressed. how do you define force majeure in the context of a pandemic, right? Which is, obviously was a pretty hot issue, right at the onset of the pandemic. But we, obviously the lawyers, along with our advice from a business standpoint, were able to negotiate favorable terms for the owner. The management company probably took a hit. I mean, obviously management companies get valued on the terms of their agreements and the fees that they charge, but it was challenging times for everyone. So, there were really not a lot of options in terms of alternative fee scenarios. Now, right after the construction was completed, the borrower got off the hook from the completion guarantee, but a restructure of the loan had not been successfully achieved. So we needed more time, and the lenders agreed to another 3-month extension of the forbearance agreement. Now, the wrinkle here is that the borrower decided that they were no longer going to fund any cash flow shortfalls because they didn't need to, right? I mean, now the leverage that the lender had from the completion guarantee was gone, and they were essentially forced to either take the keys back or to fund protective advances. And because the lenders were not ready to own the hotel, they decided to fund cash flow shortfalls. That became a whole production because we had to implement weekly calls with the general manager, weekly calls to review cash flow. I mean, this was literally a week-to-week exercise in making sure that we knew where each penny was going and what was being spent. So a pretty I think in the context of the pandemic, I think everybody else was doing probably the same thing. Then right after the extension was negotiated, the restructuring of the loan kind of took the main effort going forward. The discussions with the majority partner didn't go anywhere. So the minority partner, because they obviously had an interest in the management of the hotel, not only were they, part owner of the asset, but they were also getting fees from the management agreement. They obviously didn't want to see this hotel being foreclosed on. So they stepped in, they brought in PPP money, they discounted their management fees, all in an effort to try to create a potential restructure of the loan. But they were asking for the lenders to stay on board for, I think it was over 7 years. So the restructuring essentially was to maintain the working relationship between the lender and the borrower for, almost nearly a decade, because I think it was actually 8 years now that I'm looking back at it. And as I mentioned earlier, the Asian bank didn't want to stay in this on the long term. So despite the best efforts from all the parties, restructuring was never achieved. And so I think that it became evident at that point in time. This is now early 2021, that the lenders were out of options, and they were going to have to take back the hotel. Now, a key issue that was giving everybody pause was the franchise agreement. And franchise agreements sometimes can get in the way because, as we all know, comfort letters allow for the assignment of the franchise agreement in the event of a foreclosure. But I guess in this situation, the banks never thought they were going to find themselves in this particular situation. And the challenge was that the franchise agreement carried a $3 million key money note that transferred to the new owner. Well, the worry was, what happens if that key money note eventually becomes an issue when we're trying to sell this hotel? Not only are we going to take a hit on whatever distressed sale or distressed value we're able to sell this hotel for, but is this key money note going to become an issue as well? We negotiated for months with the brand. And another issue that was brought up is the fact that, negotiations of franchise agreements typically allow for the brands to tell you, well, here's another PIP, property improvement plan for your hotel. You need to renovate X, Y, and Z. Unless you do this, I will not grant you the right to use my brand. But here we were with a hotel that had just gone through a $10 million renovation, and we stressed the fact that we wanted to negotiate with the brand, but we didn't want the key money note, and we didn't want for the hotel to be picked again. It literally took about 5 months to be able to successfully get the brands to work with us, and eventually got a waiver for the key money note, and no PIP until 2025. So that was a big win for the lenders, which I think eventually helped them bridge, or get into a comfort zone where they said, we're ready to move forward with the ownership of this hotel. Essentially a year after the initial default from the borrower, the lenders took back the asset via deed in lieu of foreclosure. And obviously during this time there were a lot of other activities that were conducted, including negotiation of a budget, which nobody knew whether it could be achieved or not, right? Under a pandemic scenario, monthly reforecast to really understand where the industry was headed, constant valuations of the asset to understand, what sort of impairment the lenders were looking at, so on and so forth. But at the end of the day, it's evident that both parties were trying to buy themselves, more time. And it was not until really we got into the second round of immunizations that the lenders started to feel a little bit more comfortable with the prospects for a potential recovery of the industry. Now, in retrospective, the fact that they were, they got to a point where they felt comfortable with that scenario, did not necessarily yield the recovery that they anticipated. They took back the keys to the asset in June of last year, and come August we had Delta, so the property went from nearly a break-even point to going negative again in terms of cash. And then we started seeing a recovery again in October, November, December timeframe, and then the Omicron variant hit. And it's been essentially all red since January all the way up until early March. So they quickly realized that despite all the best efforts to really understand what the potential path of recovery might look like, there's really no crystal ball, right? And they are living that now firsthand. And hopefully things are starting to look up a little better now. I think from a performance perspective, New York is starting to recover. We're seeing that in the month of March. Summer looks strong, and I think that may pave the path for them to start thinking about a potential exit scenario that may actually turn out to be a lot sooner than they anticipated. Again, I think it was a fairly interesting project. It will be interesting to see how this new trend develop. And what I mean by new trend is we're starting to see a recovery in the industry. And I think that a lot of lenders could potentially start losing their patience or not be willing to play ball anymore, because now they have visibility, and they may well say, look, we've tried everything we can, and if we can come to an agreement, we'll just take the keys back and sell our hotel, because now we know what's the likely scenario to take place going forward. So with that, I'll conclude my presentation. I thank everyone, and obviously open the floor for any questions that you guys may have. Thanks again.
Thank you, Manuel. That's very interesting scenario. Thanks for sharing that with us. So I have a question. It's a little out of my league. I'm not sure of it, but there's enough workout people in here. When there's a deed in lieu situation that you referenced, do we still have the significant potential income tax implications for the debt being forgiven? Is that?
Well, I'm not a tax expert.
Yeah.
But I think that the short answer is, that the income tax to the seller is still real, right?
Yeah.
You still have to obviously pay for transfer taxes in connection with the transaction and whatnot.
Mm-hmm.
From a buyer's perspective, we're actually going through tax season right now, and they're preparing our tax returns, and we are paying for taxes. So I think that there's no way around it. You still have to pay them.
Roger, you have a thought on that, or is it you?
I'm not a tax attorney, but I've done plenty.
Everybody's got the disclaimer, right?
Right, but I've done a lot of deeds in lieu, and that's just a method of conveyance, right? A lot of times it's exempt from transfer taxes, but in terms of debt forgiveness, if that's what we're talking about, the income from debt forgiveness, I don't see why that would make a difference.
Yeah, I was just curious if that's still.
And it also depends on how ultimately the financial institution wants to treat that internally, right? Is it written off, right? Because at the end of the day, they might be writing off the amount of the loan, but taking back, from a balance sheet perspective, an asset, right? And essentially making that exchange. But how that's treated, it just depends from one institution to the next.
Sure. And you mentioned in your talk that I think you said you're starting to see some M&A activity, or maybe that was a conversation I had with Chuck. Are you starting to see that more? Are you starting to feel that bubble up a little more now?
Yeah, definitely, especially now that the industry is recovering, right? But we were quite busy with M&A in 2020 and 2021. Mostly what we're seeing now is a pretty interesting trend from third-party managers that are now looking south of the border, right? So we actually helped Inbridge Hospitality acquire Prisma back in middle of last year. We closed on June 1st, and now Inbridge has presence not only in Europe and obviously the US. They already had presence in the Caribbean, but now they have essentially the top third-party manager in Mexico, and they're looking to expand, into South America. We didn't work with Highgate, but Highgate also just recently acquired Trust Hospitality, which had a number of assets in the Caribbean and Mexico, and I think they were looking at acquiring something in Peru as well. And we also work with the private equity firm out of the US looking to acquire a pretty large third-party manager, probably about 60 hotels or so, out of Colombia that essentially has operations in Colombia, Peru, Ecuador, Chile, Argentina, and most of the Central American countries. So pretty active space, if you ask me.
Speaking of South America, the elections are interesting down there, right? And Colombia is getting ready to have an election that may go a little more to the left than some of the business people want. But my question is, you saw that happen in Peru. Argentina's kind of had that. Chile has kind of been in that space for a while. But are you seeing people put the brakes on until those things settle down, or is everybody just the opportunities there, so we're going to go?
Generally speaking, I think the short answer is it depends on the market. For instance, we saw markets like Peru where, yes, the recent events with respect to the switch of government had an impact on investment and lodging activity and essentially real estate development overall, right? Other countries like like Mexico, for instance, which also has a leftist president, hasn't really impacted that much. I think that the concerns in Mexico are more around safety and security than they are necessarily government related. But I think it just depends on the country, to be honest with you. Some of them there has been some challenges, and in others it's just business as usual.
So much the threat of nationalization then by the government you haven't seen it, at least that extent. Yeah.
Not any nationalizations that we're aware of.
Yeah. Thank you, Manuel. Appreciate it
Happy to be
greatly.
here.
Thanks
Thank
for
you.
joining us. Thanks, everybody.